The first day of an initial public offering often captures the world's attention. Headlines celebrate soaring prices, anxious investors chase momentum, and fear of missing out spreads rapidly. Yet history quietly whispers another story. Some of the greatest long-term opportunities have appeared not during spectacular launches, but after unexpected declines. Those moments reveal something far more valuable than market movement. They reveal the hidden psychology of wealth. Most people believe wealth is created by predicting prices. In reality, wealth is often created by understanding human behavior. A falling newly listed company can trigger disappointment, panic, and regret, even when nothing meaningful has changed about its long-term potential. The market is not simply exchanging financial assets. Every second, it is exchanging confidence, fear, patience, and expectation. Prices become a mirror reflecting the emotional state of millions of people. Why does a temporary decline feel so painful? Behavioral psychology offers an answer. Human beings naturally experience losses more intensely than gains. The mind interprets falling prices as personal failure, even when no permanent loss has occurred. This emotional shortcut once helped our ancestors survive danger, but in modern financial systems, it often becomes an invisible obstacle. The greatest investment challenge is rarely external uncertainty. It is internal impatience. Technology has amplified this challenge. Intelligent automation, advanced computing, and digital financial ecosystems deliver information every moment. While this creates unprecedented access to knowledge, it also floods the human mind with endless emotional signals. Every notification encourages immediate reaction. Every opinion demands urgency. Yet wisdom has never depended on speed. It depends on clarity. The most successful decision is often the one made after emotional noise has settled. Economics teaches another fascinating lesson. Capital constantly moves between excitement and value. During periods of extreme enthusiasm, expectations rise faster than reality. Later, when optimism fades, prices may decline even if the underlying business continues improving. This transition is uncomfortable because human attention naturally follows excitement rather than quiet progress. Wealth often accumulates where attention disappears, not where applause is loudest. History repeatedly demonstrates that civilizations, businesses, and individuals prosper through disciplined patience rather than emotional intensity. Great builders focused on creating enduring value while others focused on temporary recognition. Markets evolve, technologies change, and industries transform, but one principle remains remarkably constant. Sustainable prosperity rewards those who distinguish temporary emotion from lasting fundamentals. This pattern extends far beyond investing. In education, meaningful learning requires accepting temporary confusion before understanding emerges. In health, long-term fitness grows through consistent habits rather than instant transformation. In relationships, trust develops slowly through repeated acts of sincerity. Every meaningful achievement experiences periods that resemble decline before revealing deeper strength. Financial markets simply make this universal principle visible through numbers. Here, the timeless wisdom of Lord Hanuman becomes profoundly relevant. His life never revolved around immediate recognition or personal reward. His extraordinary strength emerged from unwavering devotion, discipline, humility, and complete focus on righteous action. When obstacles appeared, he did not allow fear to control his decisions. When success arrived, he remained humble. This balance represents one of the greatest psychological advantages any individual can cultivate. A disciplined mind observes temporary turbulence without surrendering permanent values. The Bhagavad Gita echoes a similar truth through the principle of karma yoga. Human beings are encouraged to perform thoughtful action without becoming enslaved by immediate outcomes. Financial wisdom reflects this philosophy beautifully. Responsible research, patient decision-making, continuous learning, and emotional discipline belong within our control. Short-term market fluctuations do not. The moment we confuse these two categories, anxiety replaces intelligence. Modern neuroscience also supports this ancient insight. Fear temporarily narrows human thinking, encouraging reactive choices instead of rational evaluation. Gratitude creates the opposite effect. A grateful mind naturally becomes calmer, more resilient, and more capable of seeing possibilities hidden beneath temporary setbacks. Gratitude is therefore not merely a spiritual practice. It is also a powerful cognitive advantage. It allows perception to expand when others become trapped by fear. Perhaps the greatest hidden wealth psychology revealed by IPO declines is this. Financial abundance begins long before money multiplies. It begins when emotional stability becomes stronger than market volatility. A person who remains thoughtful during uncertainty develops a form of inner capital that no economic cycle can erase. This invisible wealth influences every future decision, every opportunity recognized, and every challenge overcome. Imagine viewing every market decline not as an enemy, but as a teacher asking a simple question. Are you reacting with fear or responding with wisdom? That single question transforms investing into personal growth. It transforms uncertainty into education. It transforms temporary disappointment into lasting maturity. As we conclude, let this topic return to its deepest meaning. IPO dips are not merely financial events. They reveal the hidden architecture of human consciousness.